Hi, welcome to episode 2 of the Introduction to Financial Markets playlist. In this episode, I want to give you a brief introduction to the actual fundamental economic meta-theories and mechanisms of what a market actually is. Because if you don't understand and you're trying to trade and invest, you are basically trying to play football without knowing the rules. And I see far too much content on YouTube which completely overlooks the fundamental economic aspect of what a financial market actually is. So please stick around for this whole video. I'm going to explain everything you need to know as a beginner. Also, before I begin, please know that I'll be posting a video to this playlist, Introduction to Financial Markets, every single Wednesday going forward. So if that's something you're interested in, if you're interested in trading and finance, please subscribe. So this brings us to where to begin. In the last episode, I talked about some of the language used in finance and in markets. This one is, what is a market, right? Because a financial market is just a type of market. So I'm going to try not use the word market too much as I go through this video. But in simple terms, a market is a place, whether it's digital, or it's a car boot sale, or if it's a town market, where buyers go to meet sellers. So it sounds like an impressive term, but that's all it is. It's a place where buyers go to buy things from sellers. And these are the two fundamental forces that act in a market: buyers and sellers. But crucially, in its application, buyers buy things from sellers at a certain price. So a market is a mechanism that buyers and sellers use to determine prices where they can buy things at and sell things at. So you have buyers and sellers in a market determining the price of something. That's a very, very elementary view of what a market fundamentally is. And so in terms of financial markets, which is the focus of this channel, that could be stocks, that could be FX, that could be commodities, it could be bonds, it could be crypto. But alternatively, it could also be car insurance, it could be cookies, it could be cakes. It's just anything, anywhere where people go to buy things from people who are selling them. And it's this force between buyers and sellers that, at least in theory, determines the price of something of a market, or at market, I should say. So to get more academic here, to get more fancy, you can think of buyers as people looking to demand something in in the market. So that's the demand for a good or a service, is how many people want to buy it. All right? And people selling things are supplying it to the market. And that leaves us with the two pure concepts of macroeconomics of supply and demand. And it's these two forces that act in a market that determine the price. And that's it. That's what you fundamentally need to understand about how much something costs at a market. It's this pressure between supply and demand. People want to buy things at the lowest possible price. Other people want to sell them at the highest possible price. And it's where these two forces meet that determines the price of something in a market. And I'm not going to get into the politics of it. That is beyond the scope of this channel. This is simply to tell you at a fundamental level what a market is. And it's the economic mechanism where supply meets demand. So that at a base level is what's fundamentally happening in economic terms, in the theory at least. So what causes the price to go up and the price of something to go down? So specifically, most of you watching this video, I'm assuming, perhaps foolishly, that you're interested in the stock market. What causes a stock price to go up? And put supply out of the equation for now. Just think of demand. When you have people, to use the assumption of what makes a stock go up, this means more people are buying the stock. The demand is increasing for the stock, and that pushes the prices up. Why? And an example I've always thought is useful to explain this concept is, I'm assuming as a kid, or maybe in your adulthood, you've used the platform eBay. It's like an auction. And imagine you're on eBay trying to buy a pair of shoes. Just as a elementary metaphorical example. You're trying to buy a pair of shoes on eBay. If you are the only person on that auction trying to buy the pair of shoes from a supplier, you're the demand, buying the shoes. If it's you and you bid 20 quid, let's say 20 US dollars or 20 euro, whatever it is, there's no other force really which counteracts that. There's no one else to outbid you and push the price up. So if you say, I'm going to pay 20 quid for these trainers, as an example, the seller can either sell you the trainers or they can take the shoes off the market, right? That's it. That's the only option they have. So they can either sell the trainers to you for 20 quid profit, or they can wait for another time when the trainer market is in higher demand, let's say. Now, to use the same example, you go, let's just say a month later, the same trainers, some headline came out that says the trainers cure cancer, whatever it is. You go and bid 20 quid again on the same pair of trainers, but someone else wants the trainers more than you, so they bid 25 quid. And if you've ever been to an auction, you know exactly how this goes. There's a higher demand for something, whatever's in supply, and so there's more, the price is inflated through an increase in demand, right? So an increase in demand pushes up the price. As more people want it, they're willing to pay more money for it, and that makes the price of whatever's being traded on the market go up, as compared to little demand where there's only ever one offer. Compare those two together. What pushes the price up further? It's more demand, right? More people trying to buy something. The other element that influences price is either a lack of supply or an excess of supply. Say there's 5 people trying to buy the trainers, but they are a bespoke set of trainers, right? There's only one pair of them in the entire world. So not that much supply. That intrinsically makes them more valuable because you can't wait. Maybe they won't come back to the market next month or years from now. Maybe this is the only opportunity you'll ever get to buy this pair of trainers, metaphorically. You're going to be willing to pay more for it. And that obviously influences how much people are going to be bidding, asking to buy for these trainers, as compared to, say there was 100 of them. Well, if there's 100 of them, that means you can buy a pair of trainers at a lower price because the demand is evenly shared across 100 different pairs of trainers and not just on one. So the price comes down with an excess of supply and it goes up with a lack of supply, right? And the inverse is true for demand. When there is an excess of demand, the price goes up. When there is a lack of demand, the price goes down. So that is just fundamental economic theory. That's what's happening when you see a market like this. It's people on the market. In this case, it's the gold market, so XAU/USD, the exchange rate between gold and the dollar. People are buying gold when it's going up. They say, hey, I want to buy gold. There's more people buying gold, and that pushes it up. And obviously when it's going down, this is people selling gold. More people are selling it than people are buying it. So what you always have to understand, it's always supply. It's these two economic forces at play in a market. It's supply, trying to get the most amount of money it possibly can, and demand, trying to buy at the lowest price possible. So it's the bid and the ask, always competing with each other. Which brings us to the next point. If there aren't enough buyers in the market, or if there isn't enough demand in the market, to use another term, the supply, the sellers, have no alternative but to lower the price to try and attract demand to whatever it is. So for example, we've seen a huge sell-off in gold the last few weeks. This is people with gold saying, okay, I want to sell this gold. but no one's buying it at this price. So I'm going to try and sell it at this price and see if anyone's going to buy it. No, we're going to have to go lower. We're going to have to go lower. We're going to have to go lower. And when there's an excess of supply on the market, so loads of people trying to sell, but not enough people buying it, keeping it that price up, what you end up with is a bear market, or a bearish move in a market, I could possibly say. Prices go down when there's people selling. Alternatively, prices go up when people are buying. All right, because it's always this battle between, well, not a battle, it's a dance, let's say, between supply and demand. Okay, when prices are going up, it's supply is saying, hey, look at all this demand we got here. I can push prices up. I can sell this piece of gold I have for even higher, and someone's going to buy it. So it's sellers trying to get as much as money as they can for selling the instrument or the asset, and it's buyers trying to get it at the lowest possible price. That, my friend, is the market. So I'm going to take you across to my gold chart now and show you exactly what that looks like on a live price chart of gold. Okay, so this is XAU/USD, or as is commonly known, gold. Okay, and you can see the date across the bottom of your screen here. This is 2022, this is 2023. So this is the weekly view. Each bar is a week. All right, and to explain these fundamental drivers, these economic drivers, supply and demand, acting on the gold, the price of gold. Here was when banks were failing. So at the end of February, beginning of March of this year, 2023 that is, we had the Silicon Valley Bank fallout and First Republic Bank and the Credit Suisse drama. If you don't know what any of that means, don't worry. Just know that banks were failing and people were freaking out, okay? So what happened here was more people were trying to buy gold than were selling it, right? The demand, the force of demand in the market overpowered the force of supply, pushing the price up, as I explained. And what we saw at the end of this week here, so this was the last week of February, we saw price of gold just go boom, up like this, look. Straight up to the high it reached towards the end of April, beginning of May, a 15% near about increase in the price of gold. And this was all on the back of people freaking out about banks failing, and they were buying gold as sort of a safety hedge. And if this interests you, by the way, guys, I will be having videos coming out explaining what drives all of these markets: gold, oil, stocks, bonds, commodities, FX, all of these things I will be doing future videos on, so please subscribe if this interests you. But just to show you what's happening here, this is demand exceeding supply, pushing prices up. And since then, we've seen the price of gold come down. Let me just put it as a year-to-date view, excuse me, so you can see the months here. Since this massive high we saw at the beginning of May, we've just seen the price of gold come all the way down to, over 10% drop. Pretty close to where it started. All right. And this is because, as it became abundantly clear that we weren't on the brink of as we weren't heading into another global financial crisis, with banks failing and bankruptcies hitting the financial system, destroying everything, as it became clearer and clearer this wasn't the case, we saw people starting to sell gold. And there were less people buying it, which pushed the price, you guessed it, down. Okay? And the last few weeks in particular, we saw a huge drop off in the price of gold on the back of Fed hawkishness. Tune in for my debriefs if you want to understand more about why this is happening. All right, so that is the economic theory that you need to understand to know what's happening when the price is going up. All right, it's demand exceeding supply or vice versa. That's what's happening. That's what drives prices. That's what a market is happening. That's what markets are for. Supply and demand meeting and determining a price, at least in theory. So in future videos, I'm going to get into the details and the fundamentals of what increases supply, or decreases demand, or vice versa. For example, in stocks, in bonds, in FX, in commodities, in crypto, what is the reason prices go up and down? And how do you know about them? And how do you trade them? And how do you invest in them? I'm going to be making videos on that in the future. Please subscribe if that's something you're interested in. And thanks for watching.